Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 23rd, and we'll see how things look for Wednesday, September 24th. Now, it was a down day for the S&P. We're working off some of the extreme readings that we were getting, mostly in the intermediate term. A few that we don't see that often in the short term. Those are working off, but it was actually more of a positive day when you look internally. The market held up better. The mega caps didn't have a good day, and when they don't have a good day, the indexes don't have a good day, and that's why we ended up finishing lower. So, right at the open, we had a flat open and we declined down below the unchanged level to go negative. And we did set an intraday all-time high right at the open, and that was enough to improve some of the internals that I'll show here in a moment, where we did see a breakout of the new highs. So that's how things actually improved. But then we found really short-term support at the daily pivot at 66.80 right there. And it looked like, okay, maybe we're going to be able to bounce up off of this. No, we declined down below S1 at 66.62. We did find support that lasted the rest of the day when we fell down to the 66.50 level, another round number, a psychological level as well, but it held. And the more it comes into play, either as support or resistance, the more it becomes a technical level as well. Then we held above the 66.50 level. We went up a little bit to close below S1. So we were down 0.55%, a little over 0.5% decline there. We're still above average with volume. Not very much, but it's still pretty healthy for right now. Now we're still positive on all time frames. We haven't even come down to the 20 period moving average yet, let alone the 50. So we're still positive in that regard when we use moving averages to show the trend. And interest rates did fall a little bit. So that seems to be under control for right now. But there's some pretty hefty economic data that'll be coming out later in the week. And it was just kind of one of those days. Not an awful lot happened as far as really hitting the news, other than a couple of things I'll bring up here. We did set intraday highs for the Dow and the S&P, but we set those right at the open and then closed lower. Mega caps and growth didn't have a really good day, and some of this can be explained. It's like these stocks have had really good runs here. Maybe it's time to take a little bit of profit. Plus, we're just in the background watching this potential weak seasonality that seems to develop. And then Fed Chair Powell was making a speech and came out and said, by many measures, for example, equity prices are fairly highly valued. That's kind of a weird way to say that, but that's kind of his fairly highly valued. That's his version of irrational exuberance. That was a statement that uh, Greenspan made back in the late 90s. It's like, okay, things are just going up. There's really no explanation for it. That's kind of the same little thing here. We'll see if that has any more carryover into that. And then we're still getting a warning sign from the S&P to VIX correlation. That hasn't gone away yet. That's still lingering in the background. And we're still okay here with showing short-term conviction. The Stochk RSI fell off the list, but Williams percent are the CCI 14 and 20 charts and stochastics. Now, all of these declined, but they're still showing good, solid, positive momentum in the short term. Intermediate term, we have the Sean trend meter, which also declined, but is still extreme, the money flow. And you notice that we're not too far away from the 20 period moving average. We dropped down with the boom indicator there, but we're still far away from the 50 period moving average. And then on the long term side, we did drop here, but we're still 10% above the 200-day simple moving average. Just keeping an eye on that level to see at other times over the last few years when we get too far away from the 200-day simple moving average, and then everything kind of comes together in the short term, that leads more to a more of a sustained decline at that point. All right, no change to the overall scenario other than the statements that Powell said, which it's like, okay, we already knew this. It's not necessarily, you know, earth-shattering information that we didn't know before about the market being overvalued. And the dollar did decline. That might have helped stocks hold up a little bit better. Interest rates were down, not very much. We're down at 4.12% with the 10-year yield. Dropping down a little bit here as far as sentiment. We were at 63. Now we're back down to 58. We are still positive with the trend. The green line's above the red line. We're above 20. We're above the moving average. So it's still a strengthening positive trend. And I should have changed this. The bias, I'm so used to just having up day after up day here. The bias should be negative since we had the down day. I'm still keeping the momentum at positive. We're still looking good in the bigger picture. Okay, we did get some economic reports. The second quarter account balance came in actually less than was expected, minus 251.3 billion. They thought it would be over 300 billion minus. Last time it was minus over 400 billion. So that's actually improving a bit there. And then I just look at the numbers here, but there is a chart that I got from another source that I'll show. The manufacturing PMI came in at 52. Now, above 50, that shows expansion, but it did come down from the reading of 53 that came out last time. The services also down a little bit from the previous reading. It did come out before at 54.5. Now it's at 53.9, but again, still above 50, showing expansion. So here is the chart of the account balance. It's negative overall, but less negative than it was before. And then this is the flash PMIs that they call those. U.S. business activity growth slowed for a second consecutive month in September, while growth was again seen across both manufacturing and services. Since it's above 50, both categories reported weakened expansions, leading to slower hiring in both cases. So a little bit of a drop off here, but still above 50, showing expansion. All right, so here we look at this every week. This is longer term with the overbought, oversold composite. This is before the decline that we saw on Tuesday. So we're still coming in at 91.68. That's pretty extreme. So even longer term, we've been seeing some overbought conditions here when we get above this 90 level. Then equity positioning still kind of holding to the same spot that it was before. Folks are still net long when it comes to stocks. And then the trailing fourth quarter net profit margin, it is going up here, coming in. They're projecting it at 12%. Where back in 1990, it was down at 5%. So you take out financials in this whole mess here. And then the 10-year yield, which has come down just a little bit, it's fallen in recent months. And that's what we've been watching. We came all the way back down to this 4% level. Now we've been bouncing back up a little bit here. So we want to keep an eye on that, even though we did decline a bit in Tuesday's session. And then the Fed funds rate, and then the trailing 12 months. This is looking back at earnings, where we are seeing the Fed funds coming down. And then this is the trailing 12 months earnings per share. And then they also mix in the forecast of looking forward here. And these are tending to line up a little bit more with each other. And then probabilities of a recession bouncing up just a little bit, but still pretty low overall for the forecast, just a little bit over 20% there. Equity positioning here, just showing that's the place to be right now. Overall, that's the dark blue line here. Actually, it's the light blue line here is overall seeing an increase there. The systematic strategies, this is where you follow a system. Here, that's the dark blue line. Let me get my lines straight here. I feel like an actor. But this is what tends to perform better when the markets are just chugging along and making new highs. The systematic approach where you don't really pay attention to what's going on in the market. You just put your money in and just let it ride at that point. That performs better under the conditions that we've been in going back to last spring, where the systematic approach, it's like, okay, we're trying to time this a little bit. Maybe I should get in, maybe I should get out. That doesn't perform as well under this environment that we've been in. And here we go, just showing how everything's overvalued. This was also echoed by Jerome Powell, but it's something that I go over in the intermarket analysis video. We've been talking about this for years, where we're coming in at 23 with the S&P, and then we have industrials, tech, and discretionary. They're even more overvalued here, actually above 30 with discretionary. And even though it's less than the S&P, communication and staples, they're still above that 20 level. You have materials all the way down here. They're right on the border of looking expensive, and then the other areas that are more fairly priced. And gold reserves, just keeping an eye on this. How long can America afford to sit out the global rush to gold? I haven't seen really anyone sitting out, but that's just me. U.S. gold reserves are now at 90-year lows. Okay, depends on what source you look at for this. while the rest of the world has pushed their holdings to 50-year highs. At one point, America held over 50% of the global gold reserves. Today, just 20%. Okay, I've seen other reports that kind of contradict this. So, and I'm not a gold expert, and I don't do gold as part of my analysis. We just keep an eye on it overall. So weekly ETF flows, what's going in, what's coming out of the market. We're seeing a lot of money going into large caps, and that's where the strength has been. And if we get a more of a decline that develops, that these are the areas that are going to be hit, and then you might see some money actually coming out of them. And then sector, relative performance. Ever since we broke out to a new all-time high, the bull market playbook, apparently they play football here, has been in full swing. Leaders leading, laggards lagging. That sounds like a Christmas song here. But this is just showing how the different sectors have performed since the S&P has been going up, and not a real surprise. These are the things that we look at all the time, and these are the big growth areas: communication, tech, and discretionary. And when they're doing better, the market does better. And the more defensive areas and even some of the cyclical areas tend to underperform. Okay, global PE, that's very high right now. We're getting expensive on a global basis. So the US stock market is far more heavily weighted to tech than the rest of the world. Yes, there's a bit of a chicken and egg issue here. Okay, but a higher tech concentration implies higher valuation. All right. Not sure what chicken and egg, which came first. All right, so here is the intraday chart, just a flat open, thinking, maybe it's going to be kind of a quiet day. But then we just drifted down. We did find some support at the daily pivot, but that didn't last very long. Then we came down, actually quickly went through S1, but then we set up some support at the 6650 level and then bounced up a little bit off of that, but still closing below S1. So not much of a change in the initial overnight session. We were pretty quiet. So most of the selling actually took place during the cash session. And we saw a little bit of a bounce at the end of the day here, but we did see both the large cap growth and value lines coming down here. But taking in the bigger context, we're still looking positive. And also dropping below the moving averages now with the S&P growth to value ratio. So we're going to keep an eye on this to see if it continues to drop. That would be more negative. So growth was down, where value was actually up a little bit, and that's the broader part of the S&P that held up a little bit better. It was also down for the mid caps, where it was up for value for the mid caps, and down, but down less for the small caps. But taking a bit of a hit here with our small cap growth to value ratio. We had been improving. We came just about up to the 50-day moving average, and now we're dropping back down. We were actually breaking out with mid cap growth to value, but that came back down. And we came up to the 50-day moving average and dropping back down with S&P growth to value. And a little bit down here after breaking out with this growth to value ratio and still kind of hanging in there pretty good. It's not that discretionary is doing all that great. You can see how it's been trailing down. Staples have just been in a dive lately, and that's what's keeping this ratio going up. So looking at the trend in the short term, above the moving average with the ADX, it's going up. It's above 20. The green line is above the red line. So we're still positive in the short term. We're still positive in the intermediate term. We did see a drop off in volume here, but it was still above average, but less than what we've seen over the last couple of days. But last Friday with this big spike, that was options expiration, and then Mondays, a lot of the time that can be some fallout of squaring up after options expiration. So here is the gamma exposure. We're still at that 6,700 level. Now we're down at 6656, rounded up to 57. So this could be offering some kind of overhead resistance. And we hit that resistance on Monday, and that was pretty much at the high. That was also R2 on the intraday pivot points. And then we've been coming down since that time. We tried to get a little bit above it at the open, but it just wasn't really going anywhere. So we're seeing a little bit of a pickup here, getting above the moving average with the VIX, both with the line chart and the bar chart. Are we going to start seeing the VIX going up, which means stocks are going down if the seasonality thing ever does really kick into gear? And we're seeing volatility of the VIX picking up. Now, it had been picking up over the last few sessions, and we're above the moving average with the bar chart and the line chart. And here we're still above the dashed line with the VIX to S&P 500 correlation. So once this tops out and starts to come down, sometimes that can be a decline. Not always. There are exceptions in here if you look at the red lines, but quite often that can be what it means. And we are drifting up just a little bit with the momentum of the VIX, where the MACD is. I stopped showing this chart for quite a while because we were pretty much flatlined here. We've just been settling in this range, but we'll see if this starts to pick up. And we declined a little bit with this fear gauge, where we were up just a little bit with this other fear gauge. So a little bit of contradiction there. A little bit of a tick down here with the daily equity put call chart. This is what could also be causing some issues. We've been coming down to really low readings with the 5-day moving average of the equity put call ratio. And when we get below this red line here, a lot of times that can suggest there might be some more short-term weakness. Now, we'll just keep watching this. If we still see more weakness after this, is it going to develop into intermediate term weakness? So that's kind of how I evaluate things. And we're also still declining, but looking a little more positive here with the 10-day moving average. It's not getting down to an extreme reading. We did see a real pickup here. So we're seeing the volatility risk premium going up as the S&P was going down. So that is also seeing some fear coming back into the market. But if you see here, the advanced decline line based on price, it actually went up, and it also went up based on volume. So even though the S&P went down, internally the market held up a little bit better. And we're actually just a little bit above zero now with the short-term advanced decline ratio, where even with the update on Monday, we had declined below it. And this is still hanging in there, just barely positive with the advanced decline ratio based on price. We're looking more healthy here based on volume. This isn't really showing any conviction right now, though. We did improve with the advanced decline oscillator, but we're still below zero. And we did see an expansion of the new highs, a little bit of an expansion of the new lows. We're still going down with the 5-day chart, but the 10-day chart is trying to turn up, but it's pretty much flatlined currently. And we did see a little bit of weakness here with accumulation distribution, but we're still above the moving average. But we declined enough to drop below the moving average here. So the boom indicator would be more negative. Longer term, we're still looking at positive. We're still positive with the Chaikin money flow. The histogram has been holding up the last few trading sessions, and the red line's going up. And we're just on the border of turning negative with the Chaikin oscillator. We declined, but we're not quite below the moving average. And we did come down with the green line, a little up a little bit with the red line here with the vortex, but it's still positive. And I hadn't shown this in a few videos either. The 10-day average of the S&P highs minus the lows, that has been declining, and that's longer term. We got above this green area here, and that's where it's showing good longer term positive momentum. But we've been drifting down for the most part over the last number of trading days. And even though we were down with the S&P, we still went up a little bit here. We're above the moving average. We were flat with the NYSE composite, which was up just a little bit. But we're seeing a little bit more weakness with the mid caps and the small caps. And this is also looking good from a broader market perspective. 5-period moving average of the highs and lows across the broad market. That's continuing to go up. And again, that's a little longer term. So the decline that we saw on Tuesday is not necessarily going to have that much of an impact. We follow this to see, okay, what is the general overall movement? Is this going up or down? And that feeds more into the short to somewhat intermediate term time frame. And we did improve a little bit here. We're just barely above 50 with those stocks above their 20-period moving averages. And to go up on a down day, because we were concerned after Monday, we went down on an up day. So we are seeing the broader part of the S&P holding up a little bit better. We advanced a little bit with the 50-period moving average study, 100 moving average study, and a little bit with the 200 moving average study. So internally, things held up. All right, so we came up to this pivot point here. We got a little bit above it, and now we're coming down from it. Is that going to produce some overhead resistance? Right now, it looks like, yes, it could, but we could easily have a good up day and break right through that. We'll be watching this to see if this is the starting point of a more substantial decline. And even though we dropped off a little bit, we were slightly above average with volume. And so the 20 and 50 and even the 200 moving average study did improve a little bit. And we declined, but we're still extreme with the Williams percent R. But the Stochk RSI has now fallen out of the extreme positive reading. We declined with the CCI 14 and 20 chart, but they're still both above 100. And then we see the force index declining a little bit here, but still above the midpoint. The stochastics in the short term are coming down. It's very touchy here, but still extreme positive. Coming down a little bit, but still extreme in the intermediate short term and rolling over a bit with the long short term stochastic. We're still okay with the short-term trend. We came down to the green line and the blue line, but they are still going up for the time being. We came back down into the +2 channel with the standard deviations chart after having been up in the +3 channel. And the balance of power did decline a little bit, but we're still hanging out above zero. We're still positive with the go, no go, darker blue bars there. We're still coming off of the highest high reading, which is positive. We're on day 100 now of this uptrend, according to the Landry light system that started way back at the beginning of May. We're also, I guess, 94 days into this other uptrend that the proper order system is seeing here. We're still going up with the TTM squeeze, but we're watching this black line to see if we get up here. That would be an extreme reading, but that is still going up even with the down day. And we declined a little bit, but we're still above zero with the ease of movement. We're still looking positive with the Arun. We did improve with the McClellan oscillator for the S&P, but we're still below zero. So we're declining based on price, but we're still going up based on volume. And that's been, you can see it as negative because we have to follow price. You can see it as positive when volume tends to lead price. And we're declining a little bit more here with the NYSE McClellan oscillator. So we're seeing a little bit more of a decline based on price. Still pretty flat here based on volume. And this is interesting. We're actually turning up both based on price and volume when we look at the Swanland trading oscillator. And we've been getting some mixed signals from this indicator. Now it actually is going up on a down day. And we're still looking good with the momentum. The PMO is positive above the moving average. We're still below the moving average and declining based on price, where we're above the moving average based on volume. Again, volume is holding up for right now. So a little bit of an improvement, but still below 50 with the PMOs that are rising. A little bit of a tick up, but below 50 with the buy signals. We're still dropping off here with the PMOs that are above zero. And we've gone from positive over to neutral with the Elder's Impulse system. We're still positive with the Parabolic SAR. We're positive with the short-term slope oscillator and the MACD. So we're still positive here. This is longer. Momentum oscillators take a little bit longer to find what is the actual momentum, and we're still positive across the short, intermediate, and long-term time frames. Still positive with the Copic curve. Declining here, but still extreme positive with the Sean trend meter. Declining, but still barely above 80 with the money flow. We did decline, but above 50 with the ultimate oscillator. Decline, but above the moving average with on-balance volume. Still in the short term, the 10, 20, and 30 period moving average study, even with the decline, we're above all the lines, and the lines are continuing to go up. And we look at the intermediate term trend, still going up with the red line and the blue line. This is based on 50 periods. That's still positive. We're still above all of the moving averages. And we did come a little bit closer to the 20 period moving average. So we're no longer extreme with the boom indicator, but we're still far away with the 50 period boom indicator. And we did decline, but we're still above that 10% level with the 200-day simple moving average. And not really moving, not going up all that much. We were down just a little bit here with the bullish percent index, but we haven't seen a lot of conviction with this lately. We were going up with the S&P, and this was just kind of chopping along. And it did decline a little bit on Tuesday, but it's not really turning negative. It's still barely above the moving average. We did see a little bit of a decline with the NYSE bullish percent index, but it's still above 50. And we saw a bit of a decline also above 50 with the NASDAQ 100 bullish percent index. No longer extreme with the intermediate term and short term RSI. So now they've already given their overbought signals. And then as far as support here, we're above this R1 pivot point. We're down 0.11% so far on the week here. This is still looking good longer term with higher highs and higher lows with the weekly bars. But we'll see. If we see more of a decline, are we going to come back down to this R1 pivot point? And we are still above the upper trend line here when we go back to 2009 looking at the trend channel. And we're still positive with the Heiken Ashi. We're positive with the Kagi. It's black and pointing up. We're positive with the Renko, positive with the three-line break. So when you look at just the S&P, it's still looking good from a trending perspective. Longer term, we actually saw a bit of an uptick here with the 150 and 200 period moving average study. Still positive on all time frames across all the different indexes. Still negative with the dollar across the board there. And so we saw energy, which had been lagging a little bit lately. It had a good day. Then we had real estate, utilities, staples. These are the more defensive areas. And healthcare is also in that category. Where discretionary, tech, communication, excuse me, they ended up being lower, and those are the growth areas. So we started off really good with the Canada, of course, setting a new all-time high. The Dow Canada got above 30,000, S&P setting a new all-time high, but you can see this was right after the open over here on the right-hand side, and then we didn't stay positive. We ended up going down with the Nasdaq crossing below 22.7 and then 22.6. We did see the healthcare have a BPI cross below 50 as well. That's more negative and that's more defensive. So a lot of red here. When you have these three big boxes, when they're negative, usually the market's negative. You also had Google's down, Meta was down, Amazon, Tesla down, Oracle down. A lot of red here. That's why the S&P ended up dropping. And we got above this R1 overhead resistance level here with the pivot point, but then we closed down below it. So this is still acting as overhead resistance for the Dow. We're neutral with the diamonds, with the Elder's Impulse system. We came back down to the R2 point here with the Nasdaq. Maybe this is providing some kind of support. We'll see if this holds or if we come back down below it. But we are now neutral after being positive with the Nasdaq. We did drop down below the R2 point here with the Nasdaq 100. So we got above it, but then now we came back down below it. So that's a little more negative that this support level didn't hold. And we're neutral with the Qs looking at the Elder's Impulse system, but we're still positive with the momentum for the Nasdaq 100, still above the trend line with the weekly chart of the Nasdaq 100. And we were down slightly here with the S&P 600 small caps, down about a quarter of a percent with the Russell 2000 small caps, but still looking fairly healthy when you look at the bar pattern. And we've gone from positive to neutral with the small caps with the Elder's Impulse system, still chugging along sideways with the mid caps. And for the third day now, they are neutral with the Elder's Impulse system. After setting an all-time high on Monday, we now came down a little bit with the Wilshire 5000 and the total US stock ETF. Also coming off of recent highs here with the FANG index. It was actually down a little bit on Monday, and then we declined over a percent on Tuesday. And the financials are still underperforming the S&P. And then here you have Apple, which was down 0.64%, Amazon down over 3%, Microsoft down over a percent, Google down a third of a percent, Meta down 1.28%, Nvidia down 2.8. See, all these percentage, this is why the S&P went down. And then Tesla, after it's really been seeing some strength lately, did pull back 1.93%. Netflix was down three quarters of a percent. Just kind of going sideways right now with its 50-day moving average and seeing a little bit of a weakening here with the short-term correlation between US and world stocks still leveling out with the longer-term correlation. And we did go up with oil. That's why energy went up. So we're back working our way back up to the mid 60s, but we're still in a downtrend with the dollar. And we did come down a little bit with the 10-year yield after we tested this 4% area a couple of times and been bouncing up. Are we going to be able to come back down? That would be more positive. If we keep going up, that of course is probably going to be more negative. And we are kind of going sideways right now with the 10-year based on price. So still looking okay with the Qs to S&P. We're dropping below the moving average with discretionary to the S&P. And we declined, but we're still above an advancing moving average when we compare large cap growth to value. We're dropping below the moving average with the large caps, declining but above the moving average with the mid caps, coming back down to the moving average with the small caps. So what's the outlook then for Wednesday? We're still positive. We're above that longer term support. That's the weekly chart, the 64, 68 level. But we're still seeing some of these negative divergences, especially I'm really picking on the summation index for the S&P. And we will get the MBA mortgage applications index as well as new home sales. And then anything geopolitical had happened. There's a speech that the president was giving in front of the UN, and there's a lot of things going on about that, but not really anything that seems to impact the stock market. And here is a look at then Thursday, we'll get initial and continuing jobless claims. We'll get the third reading of GDP. We're also going to get durable goods, and then the big inflation report will be on Friday with the core PCE. So here's a look at Wednesday with new home sales coming out. I don't pay much attention to the crude oil inventories. It's on the list here, but I don't really follow that all that closely. Seasonally, a little bit better than what we've seen over the last couple of days. We're neutral to negative across the board with the Dow, S&P, and Nasdaq for September 24th. We are dealing with the week after options expiration, which tends to be down more than up, going back to 1980. And we do level out a little bit here as far as the seasonal chart. We haven't really followed this all that close. We've been setting highs, and then we had a down day on Tuesday, but we'll see if we can pick up and start to go back in the same general step as seasonality. And this also shows how September ends up being negative. This also shows how September is negative. We're in the second half of September, which is the worst performing half month going back to 1950. And I actually swapped out the other chart I was looking at. This shows that late September is historically weak. This is put out by Carson. So we'll see. Are we going to see some weakness as we start to finish out the month of September? This also shows going back to 1950 how September is usually negative. So I'm put the smart money indicators over on the negative side now because we're seeing some weakness in accumulation distribution. Still positive with the Chaikin money flow. We did decline with the Chaikin oscillator, but we haven't quite dropped below the moving average. And we are negative with the NYSE and S&P McClellan oscillators and summation indexes. This is the internal measure that I'm referring to, where we're not seeing a lot of broad strength in the S&P. But to see the moving averages and even these indicators, the McClellan oscillators and not the summation index, but we did see an improvement, even though the S&P was down. Then on the positive side, our growth to value ratios, discretionary to staples ratios, those are still looking good. We're going up now with the Swanland Trading Oscillator. The parabolic SCR, the momentum oscillators are positive. Bullish percent indexes, not really showing a lot of conviction, but still hanging on to being positive. Ease of movement, money flow, and ultimate oscillator are positive, with the money flow still being extreme. And the vortex is also still positive, and the momentum for the NASDAQ 100 is positive. Financial sector, when you look at it by itself, but still underperforming the S&P on a ratio basis. And then the long-term special K chart is still positive there. Here are the pivot points for Wednesday's session, which are available on the website or on the YouTube community tab. So our conclusion, not really changing anything here. We're still positive on all time frames, and we're above that longer term support level. In the short term, we're still showing it weakened a bit on Tuesday, but still we're seeing positive conviction there. We're going to be watching the 20 period moving averages if we see more declines. And we're seeing some improvements in the intermediate term, but also some weakening with the negative divergence. And again, I'm mainly focusing on the McClellan oscillator, where we're still declining based on price, going up based on volume. And long term, we are still positive, but we're still above that 10% level when we look at the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.